We're on the second half of the semester, and as I was just discussing with the classmate, I think that this chapter will be a nice break for you. I believe it's going to be less difficult, make a lot of logical sense to you. So my hope today is to break the chapter down, as always, to get our hands dirty and do examples. And then, of course, you're always welcome to ask questions, whether it's in a live class or whether it's via email. Okay, so here's our agenda. We're going to talk about an overview today of what variable costing is. By the way, I want to make sure that you guys understand, and I don't think the author did that great of a job of reinforcing the fact that you know half of this chapter already. This chapter is on two basic costing methods. One is the traditional costing that we've been using all along here. The fact that we did chapters on job order costing and process costing, both of those used absorption costing. So you may not have heard the term before, but it's what we've been doing. And that word absorption just means that all of the production costs are absorbed into the product. So those three product costs, direct materials, direct labor, and all the factory overhead, that's what we've been doing now for 10 weeks. So you already know half of the chapter. You can already do an income statement, a traditional GAAP income statement using absorption costing. You'll see examples of that today. The new part of this chapter is the variable costing. And by the way, someplace in your notes, most people will refer to this as direct costing. So in your notes, you'll hear me use the words interchangeably, variable costing or direct costing. They're the same thing. And although variable costing is not allowable for GAAP purposes, for external reporting purposes, and we'll talk more about that, it is widely used to help management make internal decision making. And you'll even see it's a way to keep some managers from purposely overproducing for higher profit sharing bonuses. We'll talk more about that in our second day. Today, we're going to talk mostly about costing products using both techniques, and we'll talk about doing income statements using both techniques. But this chapter is important because this whole class, managerial accounting, is mostly about internal decisions to be made internally. So we don't have to be in accordance with GAAP. We don't have to do things because GAAP says we have to do something. We're more interested in helping management make wise decisions internally. That's why this chapter is important. So as I just mentioned, we're going to focus today on the cost of the products using both methods. Again, one you're already really good at because we've been talking about absorption costing. And then we'll do income statements using both methods. And again, you're really good at doing GAAP income statements. The challenge will be to utilize the new direct costing to do those things. And then we'll talk about some decisions and why variable costing shines on some of these decisions related to typically special pricing models, and also what I just mentioned, preventing the overproduction of products just so that managers can gain a profit sharing bonus. You'll see more of that next time. So that's where we're headed. Any questions on either the schedule or the agenda for today? Okay, there's two handouts for this chapter, so we should have both of them pulled up as we either watch the video live or watch it recorded at a later date. There's two handouts. There's this one, and then there's one that's called the Surfboard handout. We're going to be using both of those today, so you might want to grab those as we're talking about it. I mentioned this. I started this handout off with, you already know half of this chapter. You already know how to cost our inventory using traditional GAAP costing methods. You may not have heard the term, but what we've been doing all along is using absorption costing or full costing, which means that all of those product costs, direct materials, direct labor, and factory overhead, those are all running through the T accounts, through the normal process of GAAP, what GAAP mandates, job order versus process costing. But sometimes, although it's great for external users, it's not that great for making internal decisions. In fact, you'll see on the last question we do today, that could actually cause us to make an incorrect managerial decision. And you'll see that in our last exercise. So I'd probably write down in my notes, go take a look at that last exercise when we're done with today's lecture and see how if we used gap costing, we'd actually be turning down business, which is profitable for us. You're going to see that. So the first costing model, the traditional gap costing or the absorption costing, is what you already know. So gap says we have to use it for external reporting and we have to use it for IRS purposes. It's what we're familiar with. It's what we've been doing. And so even prior to walking in today, if I were to ask you, how do you compute a fully costed good, most of you would know that there's 3 product costs that go into the making of those goods, all goods. And those 3 product costs are direct materials, direct labor, and all the factory overhead. And if I asked you how much did 1 unit cost, you would take that numerator of those 3 costs, you'd add them all up, and you would divide by the number of units produced. And that's what we've been doing. We've also been following along with this traditional income statement format. So today we're going to practice that again. The focus is going to be on cost of goods sold because again, we're talking about product costing. Remember back to previous chapters that these product costs find themselves in one of 2 places. If the goods are sold, they're sitting in cost of goods sold. And if the goods are not sold, they're sitting in a balance sheet account someplace. So that's what we've been doing all of this time. So when we do this traditional income statement today, I don't think you're going to have any problems on it because we have been studying it for a while. So the new part is called variable costing. And again, I put in also known as direct costing. And although we can't use it to create our financial statements, it is helpful for internal decisions because it focuses on controllable costs, right? Controllable costs are the costs that we have the ability to control. We know that some costs are fixed. They're usually fixed, although they don't have to be, but some costs are fixed and there's nothing we can do to change it, right? I'm looking right now at an insurance bill. Right before class started, I was texting a friend of mine saying, I can't believe how much homeowners insurance is going up. Right. So if you think about property insurance on a building, if we're thinking about a manufacturing environment, that cost of that factory, of insuring that factory, is going to be the same whether we make 5,000 units, 10,000 units, 30,000 units. It's pretty much an uncontrollable cost. And so it makes sense then to take it out of the mix when we're going to be making decisions about maybe special orders that we're going to be accepting. And so the appeal of variable costing is it tends to focus on the controllable costs, the ones that we can control. We can either decide to do something or not decide to do something. And it takes the controllable costs and immediately expenses them, or I should say it takes the uncontrollable costs and immediately expenses them on the income statement to take them out of the decision mix. So we're going to learn how to use it, but here's the basic premise right here. The premise is for variable costing or direct costing. The premise is that product costs are made up of direct materials, okay, same as the traditional, direct labor, same as the traditional. Here's the big difference. Only the variable overhead. Okay, so stop for a second. GAAP says for external uses using absorption costing, that product costs are made up of 3 things: direct materials, direct labor, and all the overhead. This premise is product costs are going to be made up of the product costs that we can control. In general, that would be the direct materials. Okay, we know that that is a controllable cost by the word direct. If we make units, we need those direct materials. And if we don't make units, we don't. That's the example of a controllable cost. Direct labor, okay, by that D, direct means we can control it. And then here's the big zinger, here's the big difference, only the variable overhead. So I want you to notice, and you'll hear me say this probably 10 times today, that the only difference between these two methods is how the fixed overhead is treated. Okay, you'll see it in big letters down here. The only difference between these two methods is how the fixed overhead is treated. Okay, think about some of those fixed overhead costs that we've talked about in the past. I just mentioned one, insuring the factory. That's a fixed cost. There's nothing we can do to change that. Yes, we could go get other quotes, but right now, insurance costs are rising as cost of living is rising throughout. That's truly an uncontrollable cost. So rather than have it be on either the income statement or the balance sheet, we're just going to take it out of the mix. Variable costing says to expense all fixed overhead costs. It's a cost of the period. Let's get it out of the way now. We don't want it on the balance sheet. We don't think it has any future value. So again, the only difference between these two methods is how the fixed overhead is treated. And down here is the major crux of this chapter. The fixed overhead is treated as a period cost. That means it's expensed immediately. Okay, that's different from what we've been doing. Fixed overhead on the GAAP side was a product cost, which means if the units were sold, it was on the income statement in cost of goods sold. But if the units remain unsold, it was sitting in a balance sheet account someplace. So that's the difference between these two methods. It's the fixed overhead. In fact, I'm going to work with you through some examples today. And what I'm going to propose to you is we can predict what the net incomes are going to be, whether we're using GAAP costing or direct costing, if we focus on two things in this chapter. Is there a swing in inventory? Okay, if the answer is yes, there is a swing in inventory, I'm going to show you how we can predict what the variable cost is going to be before we ever set out to do that variable costing income statement. I know that sounds a little confusing right now, but when we get our hands dirty, I'm going to prove it to you. Okay, so what else is different? We're not going to use that GAAP income statement anymore. I think I pretty much mentioned that we would be focusing for much of the semester on this new managerial, or we learned it as a contribution margin income statement. And it's going to look like this. This won't be the first time you've seen this. We're going to take sales less all the variable cost. And when I say all, I mean both the manufacturing side and the selling and administrative side. We'll get this thing called the contribution margin, which we learn can be so helpful in helping us make predictions, and we'll continue to use that. And then we're going to take out all the fixed cost. Here's the change. The fixed overhead is 100% expensed under direct costing. We're going to take it out of the decision mix. Why? Because it doesn't matter what we do internally. We're going to incur those fixed costs, whether we accept a special selling price, whether we don't, whether we decide to make more units or not. We want to take it out of the mix because it's a non-controllable cost. And that'll give us our net income. When we create our income statements, there's going to be 3 different conditions. And by the way, this would be the same with any company. There's 3 things that can happen. Okay, number 1 is you produce a certain number and you sell a certain number. So here's the first scenario. When units produced equals the units sold. Okay, in other words, I make 10,000 and I sell 10,000. What you're going to see in a second with the surfboard example, there is no difference in net income. Okay, why? Let me go back to the premise of this chapter. The only difference between these two methods is how the fixed overhead is treated. Well, if there's no inventory because you've sold all that you've made, 100% of that overhead cost is in cost of goods sold on a traditional income statement. And on a variable costing income statement, 100% of those factory overhead costs are going to be expensed. So net income is going to be exactly the same. I'm going to prove this to you in a minute. The second scenario, which I think happens with most businesses produce more than they want to sell to be ready for increased demand and so forth. So an example of this, I'm just pulling numbers out of the air right now. An example of this would be if we made 10,000, but we only sold 8,000. Okay, remember what's going to happen on these two income statements. And this is probably time number 4 or 5. The only difference between these two methods is how the fixed overhead is treated. So if we make more units than we sell, cost of goods sold is only going to have a partial expense, only those 8,000 units that we sold. The rest of that cost is going to be on the balance sheet. However, on the variable costing side, this is the new one, 100% of those units that we made, as far as the fixed overhead cost goes, is going to be expensed. So what does that mean? When you have more expense on the income statement, your net income is going to be lower than it would be under GAAP costing. In fact, I can tell you exactly how much lower it's going to be. And I'm going to get you in the mindset and in the practice of computing that. I'm going to have you compute what would net income be under direct costing using your critical thinking skills, and then we'll prove it by doing an income statement. So why would the direct costing income be lower? Because 100% of the fixed cost is automatically expensed under direct costing. So how much will it be lower by? The only difference between these two methods is how the fixed overhead is treated. So it will be lower by the amount of the inventory swing times the fixed overhead cost per unit. Okay, in my example, I think my cord is not plugged in. Excuse me real quick. I don't want to lose you guys. I got to replace that cord. I think it's back up again. Yes. I lost my handout here. Give me 1 second. Oh boy. Excuse me for the interruption. My computer is like stalling. Well, let's just go back to what we were talking about. The only difference between these two is how the fixed overhead is going to be expensed under direct costing. So using our little example that I pulled out of the air here, if we made 10,000, but we sold 8,000, the swing there is we have 2,000 units in inventory. Since the only difference between these two methods is how that fixed overhead is treated, partially expensed under GAAP costing, because the rest is on the balance sheet, fully expensed under direct costing. And so direct costing net income is going to be lower by those 2,000 units times whatever the fixed overhead cost per unit is. That's how we're going to be computing our net income ahead of time when we have inventory left on hand. So that'll become clear when we jump in. Any questions so far? Okay, the third condition that can happen, and I'm going to tell you right now, I'm not going to emphasize this hardly at all in the class because I don't see it happen too often, is when you sell more than you can produce. Okay, what the heck does that mean? How would that even happen, right? If we're making 10,000 units, how in the world could we sell 12,000? And the answer is there would have to be some inventory left over from a previous year. I don't see that happening too often. So I'm going to focus on these first two scenarios. The answer to the question of what happens is exactly flipped. So the net income will be higher on the direct costing side. It hardly ever happens. And so my focus for our purposes in this class, being kind of an introduction to what managerial accounting is, my focus and the test focus is going to be on these two scenarios. So we're going to do this surfboard example here in a minute, and we're going to produce 10,000 surfboards and we're going to sell 10,000 surfboards. And you're going to see that there's going to be no difference in the net income. And then we're going to take that same example, the surfboard example. This time we're going to do what I usually see happen in practice, where they make more units than they sell. And that's because most manufacturers like to have what we call safety stock. We like to have extra units there just in case we don't get a good hold of our demand, what our demand's going to be. We want to be able to sell to the customer when they want it. So there's overproduction. And then what do you do with those excess units? There's different ways of thinking about it. You can donate them to charity. You can do lots of things with them. But I usually see companies making more than what they sell. Okay, so let's go jump in to this surfboard example. And this is under the modules link. It's the second handout that you'll see. And I come from a family of surfers. I've never done it myself other than, well, I shouldn't say I've never tried it. I wasn't very good at it. And I just said, that's enough for me. I'll watch from the beach. Okay, but I don't know anything about surfboards, so these costs are low. It wasn't meant to be a realistic example. It was meant to be a theoretical example. So here we go. In the past, the company's made 10,000 surfboards. The following information's been gathered by the financial records. I know surfboards sell for a lot more, but again, we're just using an example here. The selling price is $50. Okay, here's our costs. Direct materials are 12, direct labor 7, variable overhead is 6, and highlight this line somewhere, somehow. The only difference between these two methods is how the fixed overhead cost is treated. So when we're working through problems, whether it be with me in the classroom or at home as you're doing your homework, go find the fixed overhead line item and highlight it, because that's what is treated differently in direct costing. And right now, I would just calculate off to the side how much that is per unit. Okay, well, remember, they made 10,000 boards. So 100,000 divided by 10,000 boards, that's $10 a unit right now. Let me write that down. Oh, you know what? I don't think it's going to let me write on a PDF file. Nope. So someplace off to the side, write down $10 a unit. Okay, the variable selling cost, that might be a commission or something, is $5 a unit. And then they have fixed selling expenses. Remember the definition of a fixed cost? It's a cost that doesn't change no matter how many units over the relevant range are produced. So that 50,000, think of that as a salary of some sort. Doesn't matter how many units we produce, the fixed selling expense, if they're truly fixed, are going to be 50,000 no matter what. Okay, so here's the two scenarios that we're going to talk about today. What is the net income going to look like? If we make and sell 10,000 boards, that's going to be our first scenario. Now, based on that short lecture that we just finished, you should be able to tell me that if we make and sell all 10,000 boards, there's going to be no difference in the net income. They're going to be equivalent, because 100% is going to be expensed under traditional costing and cost of goods sold. And in direct costing, that fixed overhead is also going to be 100% expense, this time as a period cost. So on that first set of facts, we're going to do an income statement using the traditional costing or absorption costing that we've done all along. And then we'll do a non-traditional or managerial type income statement, remembering that we're going to expense always 100% of the fixed overhead. So we're going to get equivalent net incomes. Okay, we're going to do that first. The second thing we're going to do once we're done with that scenario, we're going to make the situation a little bit different. We are going to make 10,000 boards, but only sell 8,000 boards. Okay, now what I want you to be thinking of right now up here, using our critical thinking skills, there's 2,000 boards that are unsold. There's a 2,000 surfboard swing in inventory. Since the only difference between these two methods is how that fixed overhead is treated, you should be able to tell me right now what's going to happen on the variable costing statement. The net income on the variable costing statement is going to be 2,000 boards times the $10 fixed overhead per unit. Let me see what that comes out to. I can probably do it in my head, but 2,000 boards times the $10 per unit fixed overhead cost. My net income, I'll tell you right now before I do it, is going to be $20,000 less on the direct costing side. Okay, because 100% of that fixed overhead is going to be expensed on the direct costing side, where only 8,000 boards are going to be expensed on the traditional costing. So I'm going to prove it to you. We're going to walk ourselves through this example, but any questions from a cognitive standpoint? Are you able to see the connection with why our net income would be lower if 100% of that overhead was expensed under direct costing? Okay, let's go prove it to ourselves. So let's go download the Excel file. Most of you have probably already done that. I'm going to pull it up. And what I did on mine, I added a new sheet and I put this surfboard example. So when you look at your downloaded file, you'll see exercise 19-1 being your first one. I just went ahead and added this new sheet. And right now it's called sheet 1. I think I'll recall that surfboard example. And you guys have the surfboard example in front of you. I just snipped this data so I wouldn't be going back and forth and driving you guys crazy. All right, so here's the first situation. The first situation is that we make 10,000 boards and we sell 10,000 boards. There's no inventory. We make 10,000 and we sell 10,000. And let me move your faces out of the way here. Okay, here's the first thing we want to do. We want to be able to do a gap or traditional, also known as in this chapter, absorption costing income statement. And then we'll do the new one, the direct costing income statement. Now, this first one that we're going to do, we should be pros at this because we've looked at product costing forever, it seems like, for up to 10 weeks, we've been looking at product costing. So this is a traditional GAAP income statement. So it's going to look like this. Then we'll go in and fill in the blanks. We're going to take sales. We're going to take out cost of goods sold. That's going to give us gross profit. Then we'll take out our operating expenses. And that will give us net income. Oh, thank you. That was nice. My hubby just bought me a Starbucks. Very blessed. Okay, so here's our data. Let's fill this in. The sales would be 10,000. Remember, we made and we sold 10,000 boards. So the sales are going to be 10,000 boards at the sales price of 50 bucks. So right off the bat, we can probably do that in our head. I don't think I'll try doing it in my head this morning. Let me let Excel do it. And there's our 500,000. Okay, cost of goods sold. We know what we're doing with cost of goods sold. I'm going to put note 1 down here. And we know that traditional costing says that there are 3 product costs: direct materials, direct labor, and all factory overhead. That's what we've been doing all along. So my goal is to get the traditional costing, cost of goods sold up there. Okay, well, looking at our little snip, again, you guys have the full handout. I just snipped part of it here. Direct materials was $12. Direct labor was $7. And all the factory overhead would be both the variable and fixed. The variable overhead was given to us at $6 per board. The fixed overhead, we said earlier, would be $10 per board. Okay, how did we get that? We took 100,000, that was the dollar value, and we divided by the number of units made. Remember, it's a production cost. So since we made 10,000 boards, we came up with a fixed overhead cost of $10 per board. So when it says all overhead, I'll put a little note on what that means. That means the variable overhead of 6, which was given, plus the $10 of fixed overhead, which we computed to be $10. So the two of those added up would be 16. Okay, so let me stop for a second. Let me let you think about that. This is the same costing we've been doing all along. We know that there's 3 product costs: direct material, direct labor, and all the factory overhead. And so all we're doing right here is adding those costs up. When I get my total here, let me do a real quick total. I'll put it in red so it stands out. I get $35 per unit. So my cost of goods sold up here, which we've delineated here in note 1, would be those 10,000 units. Whoops, did not want to do that. 10,000 units at 35. The 35 came from that red number down below. So again, going back to what we already know, cost of goods sold would be $350. That means my gross profit is the difference. Let me stop. Give you guys a chance, as always, to ask questions. Okay, my operating expenses are general and administrative and selling. Okay, in this case, it doesn't look like they have any G&A, so we're just left with selling here. It would be all the operating expenses that we have. So there would be 2 kinds in here. We got the variable at $5 a unit. So I'm going to write in here variable. Selling would be 50,000, right? $5 a unit times 10,000 boards, as well as the fixed selling of 50,000 that's given to us. So those operating expenses are going to be 100,000. The sum of those two. My net income using traditional GAAP costing, which we've been doing now for quite some time, would be 50,000. Okay, that is not new. That's what we've been doing. Any questions on that? Okay, here comes the new part. The new part is this new costing technique that, although not acceptable for GAAP purposes, does help us make some short-run decisions on things like special pricing, on things about overproducing. Should we make enough of this to maybe last us for the next year or not? If not, why not? We'll do more of that next time. So this is direct costing. And the difference in direct costing is one thing, how the fixed overhead is treated. That's why I really want you guys to focus on any problem. I would start off by circling the fixed overhead. That is the only difference in these two costing methods. It will be, could be partially expensed under traditional, but it'll always be fully expensed under direct costing. Now, you probably remember back to the lecture earlier, if the units made are equal to the units sold, there's not going to be any change in the net incomes. That is, right now, I could tell you that net income under direct costing is also going to be 50,000. How could I tell you that confidently? Because all 10,000 boards were sold. There is no inventory on hand. None of those boards are on the balance sheet right now because they were all sold. So they're going to be 100% expensed in cost of goods sold. We saw that. And direct costing, they will always be 100% expensed. So we're going to change the way our income statement looks. we're not going to use that traditional costing. We're going to take our sales and we're going to take out our variable costs, and that'll give us this all too familiar contribution margin, which you guys did an awesome job on your test, understanding the importance of that concept. I was so happy. And then we're going to take out our fixed costs, and that's going to give us our net income. And my prediction up ahead, I will always write my prediction on the top because I want you guys to get in the habit of knowing that your answer's right. My prediction is the net incomes are going to be the same. And the reason is there is no inventory on this one. We made 10,000 and we sold 10,000. So my sales are identical, 10,000 units at 50,000. That's not changing. My variable costs here, it looks like we got two kinds. In fact, I think I'll go put another note down here rather than try and cram it all in there. So let's come down here and put in note 2. My variable production costs are going to be direct materials, direct labor, but only my variable overhead, just the variable overhead, because we're looking at variable costs right now. Go take a look at my notes here. Okay, and in addition to that, remember it's all variable costs. I also had a variable selling expense of $5. Okay, so let's pop these numbers in. The same 12, the same 7, the same variable overhead that we used earlier was 6. Press my escape button there. And then this variable selling expense that we had was 5. Let me add them up, and the total variable costs, that means per unit, they vary with production. Let's sum that up. I'll make that red so it stands out. So my variable costs are going to be the 10,000 units times, what happened to my red number? Times $30. Okay, we'll go ahead and compute that. The variable costs there are 300,000 when you do the math. That means my contribution margin, we spent a whole chapter and we'll spend many more chapters talking about the importance of that contribution margin. Right now is 200,000. Now I'm going to take out my fixed costs. There were 2 of them. There was the fixed overhead that is going to be expensed immediately, that 100,000. And there was the fixed selling, which was 50,000. So that would be 150,000. And that means my net income, as we predicted, is exactly the same because there was no inventory swing. So that just proves one of the things we talked about in the lecture is that if the units made equal the units sold, it doesn't matter which method we use, we're going to wind up with equivalent units or equivalent net incomes. The second scenario, I think, is going to be a little bit more challenging. The second scenario is going to be what happens if we make 10,000 boards, but we don't sell them all. Okay, so let me stop and give you guys a chance to ask questions. And then we'll move on to probably the little bit more difficult part to understand on direct costing. Okay. Scenario number 2, unless you guys have questions, speak up. Scenario number 2, we make 10,000 again. So that part's not changing, but we sell only 8,000. I want you to think about that. My first question, is there an inventory swing? And the answer is yes. Inventory is at 2,000 units. Why? We made 10,000, but we only sold 8,000. that means we have 2,000 units in inventory. Now I can predict right now, and hopefully you will be able to as we get on in the chapter and we practice this more and more. I can predict right now the change in my net income between these two methods. How can I do that? The only change between these two methods is how that fixed overhead cost is treated. It's going to be partially expensed in cost of goods sold because 2,000 units are still on the balance sheet under traditional costing. But under direct costing, all of that 100,000 is going to be expensed because that's what we do in direct costing. We take those uncontrollable costs and we expense them immediately. So what does that mean? It means that our direct costing net income is going to be lower because it has more expense. How much lower? 2,000 units times the fixed overhead cost of $10 per unit means that there's going to be a difference between the net incomes of $20,000. And I'm going to tell you right now, my direct costing is going to be lower. So as soon as I do a traditional costing income statement with those set of facts, I can tell you what net income is going to be on direct costing. It's going to be $20,000 lower. So we'll prove it to ourselves. So in the interest of time, let me just copy down the same format that we used right down here. And here will be our first scenario. And I'm going to do the same thing with the contribution margin. All I'm doing is, in the interest of time, just going through here and listing the same format. Now we'll probably have to change some of these numbers, but at least we have our format down. Okay, so here's scenario 2. If you understand this when we're done with it, and you're able to do 1 or 2 of the homework problems with me and project out for yourself what's going to happen on the second income statement, you will have this down. Okay, so the sales, remember we made 10,000, but we sold 8,000. So my sales are going to be 8,000 units at 50 bucks. Okay, let's go ahead and do that. 8,000 times 50 bucks. So my sales are 400,000. It says cost of goods sold. It does not say cost of goods made. It says cost of goods sold. So if we sold 8,000, that means we have costs on the income statement for 8,000 units. You might be saying, well, where's the other 2,000? On the balance sheet somewhere in some inventory account. So the biggest problem I'll see on an exam is people will expense the 10,000 units. It doesn't say cost of goods made. It says cost of goods sold. So, and I have 50 in there by mistake. I want to put in there that 35 that we came up with, that same 35 from last time. I was so interested in the units, I wasn't paying attention to that cost there. So 8,000 units times 35, let's do that. 8,000 times 35, I got 280. That means the gross profit under this scenario is 120 less the operating expenses. Okay, the operating expenses are the variable selling, which we said was $5 a unit times 8,000 units. So there's 40,000. In addition to that, the fixed selling, remember that fixed means just that. It's a fixed amount, like a salary of some sort, no matter how many units are either produced or sold. So that would be the other 50,000. So go ahead and do that. And once you do that and you add those together, you'll get 90,000. And so my net income in this scenario is 30,000. Let me stop. Let you ask questions. That's a gap scenario. That's not the new part. The new part is the direct costing. So this income statement is going to change. Here's what I want to ask you guys. I'm going to put a yellow number there. Do you think you can guess at what net income is going to be under direct costing? Anybody want to give it a shot? Let's go back to what we predicted. We know that there is a swing in inventory, and we know that the only difference between these two methods is how that fixed overhead is treated. On this side, we only expensed 8,000 units. Under direct costing, we're going to expense all the fixed overhead. So what that means is, because we have more expense, our net income is going to be lower. By how much? By 20,000. So I'm predicting right now, before I even do this income statement, my net income is going to be 10,000. Why? There's 2,000 units sitting in inventory using traditional gap costing, but those same units are expensed using direct costing. The only difference between these two methods is how that fixed overhead is treated. Okay, so let's go prove it to ourselves. But again, please ask questions if you have them. All right, sales of 400, that's not changing. Less the variable costs. Well, we did a calculation and we came up with $30. So that's not going to change. We're going to do our 8,000 units times $30. That's that red number above. So that's going to give us 240. The contribution margin will be the difference. And my fixed cost, this is where the difference in treatment comes in, is comprised of two things. It's the fixed production. We'll call it, let me fit it in there. And it's the fixed selling. Both. The fixed production costs are 100% fixed. And I'm going to highlight that line once I get the right number of zeros. The only difference between these two methods is how that fixed overhead or fixed production cost is treated. It is 100% expensed here, even though some of that inventory is on the balance sheet for traditional costing. That's the difference in treatment. And so my fixed selling expenses were 50, that didn't change. And I set out to prove that my prediction of $10,000 was going to be on that bottom line. And when you do the math, you see that our prediction was true. So we're going to focus on two things during our exercises today. We're going to focus on product costing using both methods. And then our focus will be, can you create these income statements? I'm going to push you even harder than the author does. I don't just want you to create the income statements. That's what he's going to ask you to do. I'm going to ask you to make a prediction before you even do the direct costing statement on what the net income, what the swing is going to be. And we just proved what we set out, that the change was 20,000 and that the direct costing was $20,000 lower than what the gap costing was. That matches this prediction that we made before we ever did that set of income statements. And you still may be asking yourself, well, why is that? Why is that happening? Or why would I need direct costing? Who wants to use direct costing if it's not gap? You're going to see that very last question we do would be an example of where gap costing, you would have turned away hundreds of thousands of dollars of business. So we're going to get there. Okay, let's go try a quick product costing problem first. Okay, 19.1 and 19.2 are going to be the same problem. One's going to have us do, I think the first one, traditional gap costing, what the author, back to Neff's question, what the author is going to now call absorption costing. And then 19.2 is going to be the exact same question. It's going to say use the same set of facts, but this time do variable costing. So first one, I'm going to write down, we are using what we've used all along. It's a new name. It's absorption, or what you may hear referred to as traditional or gap costing. And what that means is the product costs are comprised of three things: direct material, direct labor, and all the factory overhead. That's what we've been doing for chapter upon chapter now. So direct materials, he gave us at $15 a unit. That would be the first line up here. Direct labor, he gave us at $16 a unit. That would be the second line up there. And now what we need is variable and fixed overhead. Okay, now I violated my own rule, which was on all of these problems, go seek out the fixed overhead, because that is going to be what's different between these two methods. Remember, these are production costs. So when I get the production cost on a per unit basis, you want to divide by the number of units produced here. So in this case, their fixed overhead was 160,000, and that benefited 20,000 units. So you might be able to do that in your head. That'll give you $8. Okay, how did I get that? 160,000 divided by the 20,000 units produced. That's the fixed overhead. That's the one that is going to change between these two methods. The variable overhead was given at 4. So if we're looking at all the overhead, just kind of in a note below, that would be the $4 in variable overhead plus the $8 in fixed overhead. Remember, gap costing, we picked up all the overhead. So that would be $12 a unit. So when I total this up, we'll call this total product cost. I'll make it a little bit bigger so you can see the word. I'll add those up. And each product would be costed at $43 using the same methods we've done all semester long. That's not the new part. So that is requirement 1 that says compute the product cost per unit using absorption. Number 2, related to that, says, what would the cost of ending finished goods be on the balance sheet? Well, I wouldn't have given you this last line here. I would not have told you that there were 6,000 units on hand. I would have made you figure it out. I would have made the statement there was no beginning inventory, and you would have had to figure out that if we produced 20 and we sold 14, there is 6,000 units sitting on that balance sheet in finished goods. So we would take those 6,000 units and we would multiply it by that $43 per unit that we got up above in red. And so that would be easy for me to calculate. 6,000 times 43 would be 258. And then number 3 says, well, what about the cost of goods sold? In other words, we got the balance sheet item. What would be on the income statement under cost of goods sold? Okay, well, we could do that too. The units sold, if I look up above, was 14,000 units. And the cost of one unit was 43 from that red number. So I could easily calculate the 14,000 times 43. Oops, I'm not sure what I did, but thank God for the undo button. 14,000 times 43, 602,000. So here's our answers in red to the question. That's what we've been doing all along. The new part is going to be next, the 19-2. So any questions on that traditional costing problem before we head over? Okay. 16-2 says same facts. But this time, instead of using traditional gap costing, let's use variable costing. And again, I'm going to write down into your notes. This problem uses variable costing, and also known as, I hear it actually referred to more in practice as direct costing. In fact, I had an interview. We were hiring a new instructor, probably, I don't know, 10 years ago or so. One of the questions we asked them was to apply variable costing techniques. And he said, could you reword? I'm not sure what you mean by variable costing. My colleague said, oh, direct costing. After that, he knew exactly what we were talking about, and he flew through the interview. So direct costing is what I hear, and it's definitely what that colleague, now he's my colleague, heard out there in practice. So this time, product costs are comprised of not everything that we've been doing. Still direct materials, still direct labor, but only the variable overhead. Why? Because as a reminder, the fixed overhead is 100% expensed under variable costing. It's taken out of the mix because it's usually something that we can't control. All right, so I'm going to have to glance back here. Direct materials was 15, direct labor was 16, and variable overhead was 4. So 15, 16, and 4. And if you need to look back at your screen, please do. I'll wait. Only the variable overhead. So you might even want to write here, variable overhead only is considered a product cost under variable costing. So when we total that up under this new costing method, this is the new part, we get $35. So to finish this off, we're going to answer the same question. The finished goods would be sitting on the balance sheet. Remember, there were 6,000 units that did not get sold. They would be sitting there at $35 a unit based on that red number we just computed. And when you do that on your calculator, I'll give you a minute, that would be sitting in ending finished goods. And as far as cost of goods sold, those were 14,000 units sold times $35 a unit. What would be sitting in cost of goods sold when we do the math is 490,000. I'll make those red. Where would the rest of those costs be? They're going to be expensed. They're going to be expensed as a period cost in the same year that all those goods are made because of the non-controllable nature that many fixed costs have. So we started off by taking a look at the per cost units under both methods. I think the bigger emphasis in this chapter is going to be what we do next. Can you do income statements using both methods? And can you also predict? I'm going to push you harder than what the book does. Can you predict, once we know what the variable costing income statement looks like, can you predict what direct costing is going to be based on what we've studied so far today?
Let's give this income statement a shot. Exercise 19-3 gives us data for a company in its first year of operations. That's important because we know there's no existing inventory. The next line says the company produced 44,000 units and sold 36,000 units at a price of $140. Okay, right off the bat, looking at how many units they made versus how many units they sold, it looks like our swing in inventory is 8,000 units. I want you to get into the habit of predicting out what the difference in net income is going to be. So we have a swing of 8,000 units, and we'll multiply that by the fixed overhead cost per unit. The fixed overhead cost per unit would be that 528,000 that they incurred in fixed overhead costs, and that benefited the production of 44,000 units during the year. So when I do that division, I come up with $12 per unit. So I'm going to project out right now that my net incomes will be different to the tune of, I think that's 96,000, to the tune of 96,000. And I know that my variable cost income statement will be $96,000 less than my GAAP or absorption costing income statement. Why? Because GAAP will have 8,000 units of that fixed overhead cost in inventory, whereas the variable costing statement treats fixed overhead as a period cost and expenses all of it. Okay, let's prove that prediction to ourselves. Number 1 says, what is the total product cost under GAAP? We know there's 3 things that go into making a GAAP product cost: direct materials of 60, direct labor of 22, and variable overhead with fixed overhead all combined would be a total of $20. How did we get that $20? 8 in variable overhead plus the 12 in fixed overhead that we just computed. Once we sum that up, we'll have our GAAP product cost that will be used in a GAAP income statement. Okay, we came up with $102. Let's do the income statement. The sales were based on 36,000 units sold, given to us up near the top, and the sales price was $140 a unit. I got sales of $5,040,000. The cost of goods sold, not made, but sold, is $102 per unit. And once again, we sold 36,000 units. So 36,000 units times that 102 GAAP cost would give us cost of goods sold, as you see on the screen. The profit would be the difference in the two. Let me put a total line in there. Then our operating expenses were given at $11 variable selling and administrative and fixed selling and administrative. So I'll calculate those two separately just for ease of understanding. $11 per unit. This is a selling and administrative expense. We would multiply that by the units sold. I believe that was 36,000. And then in addition to that, fixed selling and administrative expense would be 105,000. Operating costs are period costs, so they're expense no matter which of these two methods we're using. And when I compute my net income by subtracting out those operating expenses, we got a net income of $867,000. Here's the question: can you tell me how much the variable costing income statement will be before we ever try it? If you look at the prediction we made at the top, you know that net income is going to be $96,000 less. So my prediction, before I even create the income statement, is going to be what it is under GAAP less that $96,000 swing due to the inventory. Let me give you a minute to see if you can crank out that variable costing income statement, and we'll be back to compare our answers. On the screen, you'll see the variable costing income statement. Product cost is different. The direct materials and direct labor are the same, but direct costing or variable costing, only the variable overhead is considered a product cost. When we added those three up, we got $90 as our product cost. The sales didn't change. The variable production costs were the number of units that we produced times the $90 per unit. We also had some variable selling, general and administrative expenses. We calculated the contribution margin by taking the sales less those variable costs. And here's where the change occurs. 100% of the fixed overhead was expensed. Most of those costs are considered uncontrollable, and so to take them out of the decision-making mix, 100% of the $528,000 was expensed as a period cost. We also had the same fixed selling, general, and administrative expenses, and our net income, or the bottom line of this income statement, was $771,000. Did our prediction come true? Were we off by the amount that we predicted we would be off by? Keep that in mind, and I would encourage you to have that mindset whenever you start out computing or preparing income statements. Let's try another one. The next few exercises will give you practice computing income statements using both methods of costing. In this exercise, they ask for an income statement using absorption and then followed up by a variable costing income statement. I would focus in on the fixed overhead line item this year. I would compute fixed overhead per unit, and then I would predict the change in the net income between the two methods. Although the author asked for variable costing in number 1, I would do the absorption costing one first, just because that's what you're most comfortable with. And if we can start off with what we're comfortable with and build up our confidence, we'll be better able then to attack the variable costing, which is the new method. I'm going to pause the video, give it a shot, and we'll come back and compare the answers. Here's the absorption or regular GAAP traditional income statement. I would encourage you to first compute the product cost using GAAP. Materials, labor, variable overhead, and the fixed overhead are all included. That came up with an amount of $200 per unit. So the first two line items are just the units sold times the selling price on the sales line item and the unit cost on the cost of goods sold line item. We came up with the gross profit, reduced gross profit by the selling and administrative expenses to come up with net income of $5,480,000. You should have predicted what the variable cost statement would look like based on the swing in inventory. Let's go take a look at that one. In this case, the product cost using variable costing is comprised of just the variable product cost. So the same direct materials and labor, but only the variable overhead. So once again, you'll see the same amount of sales. You'll see the variable cost of goods sold out was computed by taking the 70,000 units times that $130 per unit. We took out the variable selling and administrative expenses at $11 a unit, calculated this all familiar contribution margin that we've spent so much time on in the past few weeks, and then took out the fixed overhead, which was 100% expensed. That's the major difference between the two costing method. And also, of course, took out our selling and administrative expenses, which are fixed. The net income was indeed smaller, and that prediction that you made at the start of the problem should have come true. Our net income should be off by the swing in inventory times the fixed overhead per unit. How'd you do? Since this problem is exactly the same as what we've done in the past few, I decided just to present this with the solution beside it. First thing I would do is take a look at the swing in inventory. It says they made 1,050 kayaks but only sold 800. Right off the bat, the swing in inventory is 250 units. And if you can calculate the fixed overhead per unit, you can calculate the change in net income. Looking down here at letter A, it tells us that the fixed overhead is $100 per unit. So that swing in inventory of 250 units times $100 in fixed overhead would be an inventory swing of $25,000. They gave us the GAAP income statement. They asked you to compute the variable costing income statement. And if you look at the difference, indeed, it is the $25,000 that we predicted. So take a look at the solution. All the information is given. This should be repetitive by now. You should have a very solid understanding of how to do income statements. And I'll probably do the same thing with the next exercise. This time we're going from a variable costing income statement that the author gives you on the left to a GAAP income statement. So we're kind of going backwards. It should be no problem. Once again, if you understand the mechanics, the very first thing I would do is to compute the change or swing in inventory. I would get the fixed overhead cost per unit. I would predict what my net income would be. And remember, we're used to doing the absorption costing first. So this time the absorption costing will be higher by that amount. Give it a shot. Check your answers very carefully. And of course, let me know if there's any questions. We have one more income statement where I'll just flash a solution. And then our last exercise will be a good reason why variable costing can help us make internal management decisions. One last example. You guys should be pros by now. And once again, they're giving us an absorption costing, and this time telling us to go with the variable costing. So on the left is the old method, on the new is the right method. The main difference between these two statements is how the fixed overhead is treated. GAAP expenses part of the overhead based on how many units are sold. The variable costing expenses 100% of the fixed overhead. Take a look at the income statement on the right. If you came up with net income of $350,000 using the variable costing income statement, consider yourself an expert, at least for this chapter. And let's finally move on to an application of how direct costing can be used for internal decisions. Finally, an example of how variable costing can be a huge benefit to companies to help them make shorter term special offers. We know that in the long run, a product or a service's price needs to be enough to cover all the costs, variable and fixed, and to generate a profit. If that wasn't the case, then we would have lots of companies going under. We're not talking about normal long-term selling prices in this example. You're going to analyze a special offer for a service company who is considering accepting a lower than normal price for a one-time special offer. Okay, this would be considered if capacity exists. In other words, in this case, we're going to be talking about a hotel. If it's high season for the hotel and they're selling out of rooms and they have waiting lists and so forth, we would tell the people seeking this special offer to take a long walk on a short pier, because we have others that are willing to pay our regular full price. So this comes up when activity is maybe at a lull or in the off seasons for companies that are seasonably based. And what you're going to see is if we consider just the gap price or the gap cost, we would have said goodbye to a profitable order that's occurring during a low time of the season. So let's read it together and talk about solving it using these variable costing principles that we've spent the past hour plus talking about. Grand Garden is a hotel with 150 suites. Its regular suite price is $250 a night. The hotel's total cost per night is $140, and it consists of the following. Notice that is a gap price. It is a fully absorbed gap cost of $140. It includes all the variable costs and all the fixed costs of offering these suites. Keep reading. The hotel manager receives an offer to hold the local bikers club meeting at the hotel in March, which is the hotel's slow season with a low occupancy rate. Okay, that means they have lots of extra rooms just sitting there vacant. The bikers club would reserve 150 suites for one night if the hotel would accept a special offer of 125. They ask you a question. What is the contribution margin from the special offer? If we were looking at a fully costed hotel suite using gap costing, we would say that the total cost per room is 140, and this biker is only offering me 125. I would send them packing if I didn't understand special offer pricing. And the reason I would have sent them packing is because what they're offering at 125 is less than the gap cost. However, this is a special one-time offer during a low season. You could make the argument that if this bikers club comes in and likes what they see, they would come back and maybe later pay a full price. So the author is correct in that we should be focusing on the contribution margin. We should be looking at the special offer revenue that was offered at $125 a night, and compare that just to the variable cost. Why? The fixed costs are fixed no matter what decision we make on this special offer. If this is a hotel, we have usually high fixed costs. We have depreciation. That building's going to be depreciated whether or not this special biking club comes in. We have manager salaries. Those managers are on duty whether or not this bikers club is going to come in. So for special offer purposes, we can ignore the fixed cost and focus on the variable cost. And again, your author correctly asked you to look at this on a contribution margin approach. So we would take the sales less the variable costs and come up with a contribution margin. The revenue at the special offer price was for 150 suites at $125 per night. That would bring us revenue, let me fix the formatting here, of $18,750. Fixed costs are fixed no matter what, so we're kind of taking those uncontrollable costs out of the mix. Let's take a look at what that would cost us. 150 suites at the variable cost only of $110 would be $16,500. If this special bikers club was to come in, we would be increasing our contribution margin by $2,250. So knowing no other facts about this offer, based strictly on the contribution margin, we would consider accepting the special order. Remember, had we looked at the gap price, we would have turned it away, saying bye-bye to $2,250. That's a really good, simple application of when direct costing can provide the better decision-making tools. There's a lot of information in this chapter, but it's pretty straightforward, and I'm hoping you'll find this one easier than previous chapters. Until next time, Professor Johnson signing out.